Good morning, folks. About to get all this underway here. Hope everyone has had a good start to their week so far. We're celebrating a most momentous occasion today. It is Taco Tuesday, August 20th, 2024. And we're coming into a market that's experienced one of the sharpest V-shaped recoveries and set for 9 days of global gains going into today, with some warning signs around the periphery. But before we get into that, let's quickly just go over a few things here. So welcome to Back to the Futures with me, Markets and Mayhem. We're going to be focusing on how I use Bookmap to analyze order flow and find potential opportunities in stocks, in futures. I know you've seen the bubbles, and folks ask me, what do they mean? What does this charting system mean? And I understand, because it does look quite a bit different than bar charts and other sorts of conventional charts. So certainly there is some explaining to do, and I'm happy to do that today. And I appreciate you all joining me. I think this will be a lot of fun. So really quick, let's get through this disclosure. All Bookmap Limited materials, information, and presentations are for educational purposes and should not be considered specific investment advice nor recommendations. A little bit about me. My trading journey began in 2005. I funded my own account and began trading stocks, then moved on to options, futures, commodities, and Forex as I expanded my horizons. In 2006, I started rolling my trading profits into long-term investments. I navigated through the great financial crisis, which helped me better appreciate the importance of understanding intermarket dynamics, momentum, and macro. I managed to get out of the way of the great financial crisis for the most part, but it was mostly luck and a focus on technical analysis that had me cautious before things began to unravel. My approach, having evolved through these trading conditions over the last almost 2 decades, is systematic, driven by momentum, price action, options flows, sentiment positioning, volume profile, and of course, the big picture. I backtest and I build my own models and systems to trade a variety of asset classes. I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data. I co-founded TraderAid in 2022 and Macrovisor in 2023 to share my experience, ideas on market opportunities, and education. I also build a number of unique tools and models, and I provide one-on-one coaching. A little bit more about some of the deals we have going on for those folks watching. If you like what you see with Bookmap, Bookmap has a great promotion with us right now. Visit traderaid.com/bookmap. You can get up to 40% off Bookmap plans. Just scroll down to the specials. Or for you all, if you'd like to check out what I do at TraderAid, the tools we build, the education we offer, the awesome community that we host, you can get 20% off of your first month or quarter using the code Mayhem20 at checkout. And the SPX Options Visualizer is back, and it is on sale for a limited time for just $39.99 a month. Visit traderaid.com/SPX to learn more. And finally, if you want to learn more about how I use Bookmap with more one-on-one attention, you can get 20% off your first coaching session using the code COACHMAP at checkout by visiting traderaid.com and clicking on coaching. And the folks at Bookmap would love for you to join us on their Discord. You can use the QR code on screen, or you can simply visit discord.com/invite/bookmap to join up. You'll enjoy more real-time educational opportunities from a number of the different folks on Bookmap, including myself. I'm there every Tuesday at 9 a.m. And I highly recommend joining up because I just think that there's a great team there. If you have any questions about how the platform works, there's also a number of awesome educators. So definitely worth checking out. So with that out of the way, we're going to dive right in to Bookmap. On screen, we've got the S&P 500. And I'm just going to bring up another chart on my screen as well, just really quickly, because we're going to focus a bit on the S&P today. I'm going to also bring up this trading view chart that I have just to show some of my pivots as we go into the trading day, okay? So as we go into today's trading day, I'd be looking for bullish trades above 56.3175 in the S&P, and I'd be looking for the opportunity to short this under 56.11. So it's a two-sided pivot. It does look like we're closest to that bullish pivot, but we've been rejected under it twice now. So we'll see what the opening bell looks like. Of course, I also have other number of areas that I look at as we go into the trading day, including the 20-minute opening range, prevailing options flows. So we'll take a look at what it shapes up to be and if there are indeed some opportunities in the price action today. But first, let's talk a little bit about what all is on screen here, because I do get questions from folks out there wondering, what does this mean? What am I seeing? What are these bubbles? So really quickly, the bubbles are showing deltas between the volume of buyers and sellers. So a red bubble is sellers dominating the tape. The larger the bubble, the more that delta is pronounced. The same is true with green bubbles. Green bubbles are buyers dominating the tape. The larger the bubble, the more that aggression is being shown. Now let's zoom out a little bit. We can see that there are levels of resting liquidity on this heat map. The heat map in Bookmap is showing you where there is and is not interest based on offers and bids. Anything above the current price is obviously an offer, below it is a bid. And so you can see areas where there's already interest in this market, like 56.20 and 56.10 on the S&P. Or if we go way down here, maybe this guy is still there. Yeah, there's over 3,000 lots waiting at 52.50 as well. I'm not quite sure who's been waiting patiently down there for so long, but certainly someone has been. And that's going to be interesting to watch to see how that all plays out. Does the order get pulled? Do we eventually see price down there and fill them? We'll see, but they've obviously been quite patient. We also really like to pay attention to icebergs and stops at TraderAid. It's one of the areas that I've kind of optimized Bookmap on my end a bit to show the more pronounced icebergs and stops. So I do want to show you all my settings because I think this is important if you're using Bookmap to kind of at least consider this. Obviously, everyone trades differently, but if you do want to replicate what you see on my screen, here's how I do it. I've got a 30-minute sample interval and a 10 standard deviation multiplier. I also don't necessarily show the canceled icons, the event volume, or the event type. I'm really just trying to aggregate the unusually large icebergs. Same thing on stops. 30-minute sample period, 10 standard deviation multiplier. I'm only showing stop runs, so it does just really show the more pronounced multi-price stop outs. So this is something that has helped me just better concentrate on where there might be a bigger impact from this sort of order flow. And at the bottom, I have an aggregation of everything that's going on from stops and icebergs. Icebergs in blue, stops in darker red. So as the trading day starts, and we're just about 20 minutes away, we're likely to see some more interesting order flow, particularly in that first 30 minutes to an hour where volume really picks up. And then, of course, the last half hour to hour as well. And below, as I mentioned, we do have the subchart. I have 4 different indicators that I track on this subchart graph, and then 4 over here as well with one difference. Whereas the subchart below is tracking on this red line, this light red line. This is the ES aggression indicator. And this is the Bookmap volume pressure imbalance indicator. And I have tweaked it a little bit, sort of like I did with stops and icebergs. So it has a threshold of 90 before it starts throwing any signal. That just shows me where there is higher levels of aggression. So as we go through the trading morning here, I will talk a little bit more about what I'm seeing these indicators and what they mean, but we'll quickly go over the radials. Liquidity differential is the difference between the amount at the bid and the ask. Icebergs are showing passive buyers. So if you're not familiar, an iceberg is a very specific order type. It doesn't just mean a large bump out in a volume profile. It's an actual passive order where the buyer or seller doesn't want to show their hand. So they use a limited size. Let's say, for example, they have 10,000 contracts that they want to sell. And let's say they don't want to spook the market, so they break it up into 2,500 contract lots. And that way, folks don't know necessarily how much they're trying to move. They just know that there's a large order there that keeps reappearing. So eventually folks see that it's an iceberg, unless of course you have a provider like Rhythmic, which is able to show that order flow and tell you whether they're on the buy or sell side. So it's a pretty distinct advantage, and the way it integrates into Bookmap is very handy for me. It does the same thing with stops. It'll show you buy or sell side stops. Now, as you noticed when I went through my settings, I do color code these green and red. So that's not how they're defaulted, but I do that just so that visually I can very quickly look at Bookmap. I can see if it's a buy or sell, iceberg or stop, what the size of it is, and if it registers to me as mattering. I also have order book liquidity on screen. You can see that up top. There's 18,000 on offer above spot. There's 25,000 on bid below spot. So you got about a 43,000 order book depth going into this trading day. I do want to see it move above 50K during the cash session just to tell me that it's decent liquidity. We had previously some weeks of pretty poor liquidity conditions in the low 40s and high 30s. That led to a higher likelihood of slippage. You had broader bid-ask spreads and just sort of this choppy trading environment where it took less volume to move price more. So that's the type of thing that you want to keep an eye on, because obviously if you're day trading or swing trading, liquidity has a negative correlation with volatility. So if there's low liquidity, there could be high volatility and vice versa, which impacts position sizing and where one may stop out. So being aware of this and having this handy indicator on screen for me is quite helpful. On the rightmost column here, you'll see named Options Visualizer. This is a Cloud Notes data add-on that I've built that adds the options flow from CBOE's SPX options. It's the largest options complex in the world, trades about 1.2 trillion of notional every day, with about half of that expiring the same day and about 75% the same trading week. Now, why is this important? Because equity futures notional value traded every day is about 450 billion. So the tail really wags the dog. We see consistently, and I post about it on social media quite often, that the most active option strikes in SPX tend to act like a magnet for price, particularly if they agree with the prevailing trend. Like if we get an opening range breakout to the upside, hot call is in excess of hot puts, usually by 1.5 to 2 to 1. That tends to be a good place to look for as an exit, because price is typically going to get pulled into that hot put or hot call, but either one, if it's the largest one and the trend is prevailing in that direction, it tends to get pulled in that direction because market makers are hedging. They're hedging their exposure as more and more folks buy. And as a result, if you're buying SPX calls, they tend to be buying ES futures contracts, which can create these magnet levels. So as we get into the first 15, 20 minutes of the trading day, we'll see these populate as we see sufficient volume from CBOE. And this can be pretty helpful to add into what Bookmap offers, being able to visualize icebergs, stops, resting liquidity, what the trading conditions are for liquidity overall, and then having the 20-minute opening range visualized right on screen. And I'll show you how I do that in just a moment. That all gives us a bit of a sense as to where the market may be going. You layer in the options flow, and that adds, in my opinion, an additional edge. So let's talk about this red line on top and green line below, because I just referenced the opening range. This makes it a lot easier for me to see. So this is the highest price level, and this is the lowest price level. And I'm going to show you how I have them configured. This is under the price levels add-on. I believe it's a free add-on from the Bookmap marketplace. Y'all can correct me if I'm wrong there. But the highest price level, I enable that. The lowest price level, I enable that. Just color code it, defaults, red and green. I disable the middle price level because I prefer to see the point of control, both in that color and just not to crowd my screen too much. And I reset these indicators every cash open at 9:30 a.m. Eastern. And why am I doing that? Because then within the first 20 minutes, the price high and price low show me the opening range. And I can look to see whether there is a break above or below and some acceptance around that level by simply having these lines on my screen. And then throughout the trading day, it also helps me to keep track as to whether or not we're making new highs or new lows just at a glance, because Bookmap is showing me the way I use it. I tend to just keep about 20, 30 minutes of data on screen. And, sometimes I'll zoom out and show the bigger picture, the overnight session, and then I'll zoom in a little bit to see the microstructure. But on average, I've got about 20 or 30 minutes on screen. So knowing where the total session price high or price low is also helpful later in the day to see if, for example, an upwardly trending day continues to push to new highs. So I'll pause there for a moment, folks. If you have any questions about anything I've discussed, please do let me know. All right. So just about 12 minutes ahead of the opening bell here. The stream runs until 10 a.m. Eastern, and I am here every Tuesday from 9 a.m. to 10 a.m. So set your calendar, join us on the Bookmap Discord, or join us on Twitter, YouTube, or Twitch, whatever you prefer. So I was asked if I see the semiconductor SMH ETF or NVIDIA in overbought conditions. And I would just say, in the context of an uptrend, overbought doesn't have a lot of meaning. And I think this is a somewhat important distinction to make, that overbought just doesn't really mean a lot. If you're in an uptrend, things tend to get overbought and stay overbought and can continue to get more overbought. It's not necessarily like an indication of imminent risk off. So I think it makes more sense to look at skew. And so what I tend to do is look at volatility skew on things like NVIDIA. And we saw that it got extraordinarily negative, right? Volatility skew on NVIDIA got extraordinarily negative, as did Triple Q and a number of other areas around that August 5th disorderly decline. A lot of late day hedging, kind of buying fire insurance when the building was already on fire, people paying incredible premium. And that actually is the best sort of oversold, if you want to say, type of indicator, in the sense that it was exhaustive. So now NVIDIA skew is back to slightly bullish levels. It's a far cry from what we saw in mid-May. Nothing that suggests it's extremely overextended. I think the biggest event risk for NVIDIA and SMH, where the ETF is like 25% NVIDIA, is NVIDIA earnings. But in terms of positioning so far right now, it doesn't suggest it's super crowded or euphoric. And just for traders out there, just as a matter of principle, it's really not about calling tops and bottoms. It's about capturing the bulk of the momentum and trying to repeat that as a strategy that becomes a system, and then you can become more consistent, right? So someone asked, do I change the two price levels manually after the first 20 minutes? I do not, because the opening range is defined by the price action of the first 20 minutes. So with the price high low indicator resetting at 9:30 a.m., it continues to adjust itself. And as we get to 9:50 a.m., I have my 20-minute opening range, right? And any move above or below that is going to give me a sense as to whether we're potentially testing that range and breaking above or below. And then I like to track that just to get a sense as to trend or momentum intraday. It doesn't stop updating. I don't want it to stop updating, because the more that it shows me, for example, if we're in a positive trend day with a breakout from the opening range, the more we continue to make new highs, the more encouraged I am about that trade up until we get to, say, a level like the hot call. So I like to have that band there, but once we've already broken out of the range, I'm more concerned about the health of the trend. Atlas asks, silver is looking constructive. Does it break out higher finally? I think it can. I think it can break, if it can break above $30.40 on a closing basis, I think silver has room to run pretty significantly. So I do use it to track the opening range, but what I really use, sorry, shifting gears just back to the question, I really use it to track a breakout or the breakdown. And then once I've seen that, I'm more concerned about continuation, right? So I like to have that range, that price range, show me whether we're continuing to make new highs on an uptrend day or whether we're making new lows on a downtrend day. But it would be nice if there was some more functionality in it where you could actually have it built to track the range and then the highs and lows. If that's something the Bookmap team adds in, I'd be all for it. Like an opening range price level indicator and tracking highs and lows. So you have 4 lines. That would be even better. CT asks, is it too late to make new positions post 8 days bull run? Well, we're actually on the 9th day here, potentially, which would be the best bull run of 2024. You know, it depends on where you're looking. I think that there are parts of the market that are still attractively valued. So for me, I'm more interested in the equal weight S&P, in the value components, in some of the areas where we're seeing earnings growth. And it's mostly that inglorious 493, right? We've heard everything about the Magnificent Seven for about the last, let's call it, 20 months. And they've been the market leadership because earnings growth has been the most impressive really in the Fantastic Five. We've got to kind of leave out Tesla and Apple because their growth has not been particularly impressive at all. But if you look at the rest of the S&P now, it's starting to grow while the Mag 7 or the Fantastic Five are starting to slow. And I think that this has been a story of fundamentals mattering the entire time. And I think they still matter. And I would argue if that's the case, then those other components should be the outperformers here. So that would be where I'm more interested in finding opportunities. But as with anything, if one is a long-term investor or a swing trader, use the volatility of the market to your advantage. Dollar cost average into things. Make a shopping list. And remember, this is still a seasonally challenging time of year. We could get a pullback. We saw the CBOE equity put call ratio drop to 0.47. That's the lowest level we've seen in quite a long time. And typically when it gets that low, it can precede a bit of a pullback. So I would say we are starting to see some signs of euphoria creeping back into this market. It's not across the board. There's plenty of indicators that are nowhere near there, but at least may give us a little pause in being too aggressive buying if we miss this initial move. So got about 6 minutes left until the open here. Tom Fox adds, what is the name of the options visualizer add-on? I don't see any add-on with that name on the Bookmap site. That is correct. It is not on the Bookmap site. I've built an API for it, and I sell it separately through a site called Nadles. So you can visit traderaid.com/SPX. That's traderaid.com/SPX to learn more about the indicator and also to consider purchasing it. There is a link there in the first paragraph of that page. And the way it works is it plugs right into Cloud Notes. There's an authentication token that verifies your subscription, and then the data populates on screen. You do need to have Rhythmic, DX Feed, or Bookmap data. It supports all three. You just need to make sure you have one of those tied to ES. And then your visualization should work just fine, and they update every minute during regular trading hours. You're welcome. Great question. Jackson Hole impact. That's a great question. So I think going into Jackson Hole, we have a market that is far too excited about the pace and depth of the Fed cutting cycle. And I'm not so sure that the market is accurately gauging this. This is why, by the way, I like Fed funds futures a lot, because they're not a predictive indicator at all. And folks, I would never suggest that they should be used that way, because quite frankly, what they're more useful for is gauging expectations and sometimes setting up trading opportunities. So if you go into Fed funds futures right now, you'll see that they're expecting a pretty aggressive rate cutting cycle. I want to say last time I looked, it was like 125. No, it was about 175 bips over the next year. Yeah, last time I looked, it was about 175 bips over the next year. I don't think we're going to get that much. And this reminds me a bit of late last year, early this year, where the market was looking for 6 to 7 cuts. And we haven't gotten any this year yet. We're looking at maybe one in September and probably another one perhaps in December. I think we might get 50 bips this year. I've been pretty consistent about that view that the market was a little too aggressive. I still feel that way. And so Jackson Hole's impact is likely to be one of Powell saying, look, yes, we are entering a cutting cycle, likely imminently, but the market may be a little more optimistic about the depth of those cuts. It's also a be careful what you wish for type of situation, isn't it? If the Fed is cutting by 175 bips over the next year, that suggests something is very wrong. That's not something that is a desirable outcome. So I would be more concerned about if the market's right, that's probably not good for the economy and that very well could translate to earnings. But I think it's more likely the market's wrong, that we do have less cuts. And so Jackson Hole could bring up rates on the short end a bit, right? Because if we have to discount the fact that maybe this won't be quite as aggressive, if Powell is effective in relaying the message, I think he will, that, the market's a little bit too optimistic, then that could push up rates on the front end. That could cause some pressure on risk assets as well. And then Atlas goes on to ask, so what do you think gold is indicating? I think gold is an incredible uncertainty hedge, and we have a lot of uncertainty in the world right now. I don't think gold is particularly a great inflation hedge, and we can see how, in many instances of inflation, it doesn't necessarily perform the way that we would hope, particularly because rates and even real rates sometimes get quite aggressive, and gold is competing with anything that generates interest, right? But when times of uncertainty rise, that's when I think gold really does shine. And I think we've got political uncertainty. I think we've got policy uncertainty, both monetary and fiscal. And I think that we've got a number of geopolitical developments around the world that are still simmering. And I think that's kind of what gold is telling us. The other thing is central banks around the world are diversifying away from dollar-denominated assets and into gold, with the 2 biggest years of central bank gold buying on record ever. And retail has not started piling into calls in gold. So I still think, and my call has been for some time, $2,600 gold in September, maybe a little earlier with the price path it's taking, $3,000 by the first half of next year. Got about a minute left until the trading day starts with the opening bell. Hope everyone out there is having a good morning. Now, SPX 5600 is a pretty big level to watch today. It's a key level in the options market. Those nice big even levels tend to attract a lot of positioning. And right now, that ends up being ES 5621.75. So that's just right where that hot call was yesterday. I think that'll be a bit of a magnet today. It's a key level of support to watch. Again, ES 5621.75. That's when we take the SPX number and we add the delta that ES has for the September contract to it, it comes out to 5621.75. So I think that's an important level to watch here. We do see a lot of passive iceberging on both sides as we get ready to start this trading day with less than a minute left. S&P cash is implied to open about flat, down 0.08%. NASDAQ down 0.17%. And we have a overall buy-side imbalance going into the market open. So long gold is an interesting trade. I mean, I think we could express it in a number of different tickers. The most liquid one is GLD. I know some folks aren't a fan of it for all variety of reasons, but if you're going to be trading it, that might be one that gets you less slippage. IAU and other tickers are also out there. There's also the Sprott Physical Gold ETF. But I also like some of the names in this space. Agnico Eagle, Wheaton Precious Metals, Sandstorm. You know, there's some decent names. Even Royal Gold could be a decent turnaround story. And then there's some really small junior miners like Rio, not to be confused with Rio Tinto, that also look pretty good to me as turnaround plays. Now, one thing that I would caution about using commodity ETFs is you're likely to get a K1 schedule. So just be prepared if you're, buying and selling commodity ETFs, it can add to your tax prep overhead. You will not see that the same way in futures as they don't come with partnership schedules and they have more preferable tax treatment on two fronts. One is you get the 60/40 treatment on gains. The second is that there is no wash sale restriction. So market is open here. We do see a little bit of a pop here on the open, right up to a level where there may be some supply from an existing sell side iceberg order. And the market on open imbalance was S&P 500 5 million, NASDAQ 20 million. Dow actually had a sell side imbalance of 20 million, and the Magnificent Seven 20 million buy side imbalance, accounting for pretty much the entire NASDAQ 100 buy side imbalance. Let's take a look at our friend, the high beta cousin of the S&P, this NASDAQ here, also getting a pretty strong pop on open. There was a pretty nice close yesterday. We got into a key level of resistance, rejected there for now. I was at 56.3175 level on ES that I'm watching today as a pivot, because I think if we do move above it, we'll probably get some decent continuation. So right now we're sort of challenging that level. It's just about where VWAP is. And folks, if you enjoy using Bookmap to visualize market data, it can be used on stocks, ETFs, futures. You can pick up a copy for up to 40% off by visiting traderaid.com/bookmap. Scroll down to the specials. And you can run it on a number of different platforms, including Windows, Mac, and even Linux, because it's Java-based. There's also a web version that can be used if you're on the go. And we can see now that the market's open. We've got our price high and price low levels, right? So we're already starting to build this range. And so far, for the first couple of minutes, it's chunky. Let's see if that continuation, that expansion builds from here. We're also starting to move above that key pivot level, which if we do start to form an opening range with that or around that as our top side, and we can start to push above it, it will look pretty good from a number of different angles, but I do want to still see what the options flow look like as well. The last several days of options flow have been incredibly tilted to the bull side. And again, as I was mentioning earlier, the CBOE equity put call ratio hit 0.47. I like looking at equity put call versus total or index. And here's why. Equity put call is a much clearer representation of the sentiment of participants. Because if you have index included, you're factoring for all kinds of hedging flows that are somewhat agnostic of price. So it can kind of distort what you're seeing. If you're looking at equities, it's mostly folks that are transacting based on their near-term views. And once it gets a little too lopsided to the call side, when it's exceeding 2 to 1, for example, which is 0.5 on that measure, that can be an early sign that people are getting just a little too excited. Doesn't mean we're going to have any crazy crash or any kind of disorderly decline. It just it increases the left tail risk that we could have a bit more of a corrective impulse. And corrections can happen in several ways. They can happen in price, they can happen in time, like a consolidation, or both. So we are starting to build above that key pivot level that I mentioned earlier, and also above VWAP. So we are starting to see some more constructive price action so far here. The Nasdaq's also confirming that. Bitcoin, not so much though. Bitcoin having a bit of a struggle off the open, as is the Russell. Now, there could be some reasons for that. I'm not a subscriber of the rotation theory, as folks that follow my work know. I think this was more hedge funds covering shorts and retail buying calls that led to the big pop in the Russell. And we're starting to see hedge funds lean back into some of their favorite macro short products, including the Russell this week. So with the Nasdaq up and the Russell down, I'd be inclined to say some of this is probably footprints of hedge funds starting to get more long tech and use the Russell as one of their favorite products to sort of off-hedge some of, or offset some of that delta, hedge out some of that positioning. Let's take a quick look at gold since we talked about it. Gold just straight dropping off the open. Now, I will say, weeks that have a lot of Fed activity, if you look at like a 10, 20-year sample period, not just like the last year or so, but a broader aggregate of data, they tend to be much more volatile for gold, with the path of least resistance often lower until the Fed is done doing whatever it is they have to do. This week, with minutes on Wednesday at 10 a.m., or I'm sorry, at Wednesday at 2 p.m. and Jackson Hole, Powell's speech 10 a.m. on Friday, that could introduce some additional volatility to gold, particularly if Powell walks back cutting expectations some more. That could be a bit net negative for gold because it could push up real rates a bit. So just something to keep in mind. That doesn't mean it changes my view on gold over the intermediate term, but it may bring us some more choppy trading conditions. Let's take a look at crude here. Contract rolled recently. There's really nothing for me to like on the chart of crude right now. I do think it's been a sort of microstructure and macrostructure downtrend. You can look at it in a number of different time frames and see that it's making lower highs and lower lows, and it looks vulnerable to potentially make a new low, you know, around 70, 71 bucks. So I would be hesitant. Now, obviously, you have offsets. If geopolitical tensions start to rise again, oil's likely to be bid. And if we get supply data from EIA that suggests that oil demand is suddenly coming back after last week's unexpected build of supply, that could also cause some bullishness in oil for now. But for right now, I'm more hesitant on it, having seen that tensions are cooling a bit, and the last week's EIA data showed a pretty large build of supply when we were expecting to see a draw. Get back to the S&P 500 here. We're still starting to sort of build above this pivot and define our opening range here, which is now just about 8 handles. And we got Johnson Red Book out this morning. The actual number came in as a year-over-year gain of 4.9%. The prior reading was 4.7%, which suggests that in nominal terms, consumers are still spending more than they did last year. Although when we look at it in real terms, it's not quite as an impressive number. If you go to Fred, the Federal Reserve's St. Louis data aggregation warehouse, and look up real retail sales, you'll see it's been flat to down for about 2.5 years, suggesting consumers are paying more to get the same or less. So, you know, it just depends on kind of what set of data you're looking at. But a lot of the more realistic interpretations are showing that at least the bottom half of consumers are continuing to struggle here. And overall, the market continues to have a somewhat bullish look to it, a bid right off the open, building above the VWAP, buyers dragging the point of control higher. And we see S&P cash and NASDAQ cash going green on the session here. S&P cash up 0.05%, NASDAQ cash up, well, now flat. It heard me talking and said, nope. Dow 30 down 0.11%, small caps down 0.17%. Let's take a look at the NASDAQ here, just to compare notes a little bit. It looks somewhat weaker than the S&P. You can see the S&P sort of moving, pushing up to new highs here. NASDAQ, comparatively speaking, struggling below the point of control and VWAP. And a rather large bid just came in the NASDAQ at 19,830. So that's interesting. And the reason I say rather large is it's all relative terms. You can see the order book of the NASDAQ has just over 9,000. So 120 contracts, or right now 110 on the bid, is actually significant for this. And we are starting to see price now just continuing to grind sideways, testing this point of control and VWAP. It does look like buyers are pushing higher now. And it also looks like that bid moved higher. It was at 810, now it's at 830. We also see there's an excess of buyers versus sellers on the bid. There's an excess of over 3,000. So that's overall constructive for the NASDAQ, which is pushing to new cash session highs. Similar look with the S&P, although I would love to see the order book depth just increase a little bit. It's just about 46,000 right now, but we do see an excess of buyers versus sellers if you're looking at bids versus offers of about 10,000 contracts. So that also is constructive overall. And pre-market, there were passive sellers just around that pivot level. They've all vacated, and it really does look like the passive buyers were a bit more aggressive pre-market. So we've now pushed up to about a 10.5 handle opening range on ES. I'd love to see it a little bit wider than that, just to suggest we have some room if we get a trend day, but we'll take what the market gives us. Yes, Paul, that's correct. It's on October for crude now. You can go to the CME website, search the symbol, and it'll show you the most active contract. You can also look at volume and see where the others are trading, just to get a sense as to when you should roll or which contract you should be watching. And Syntax Trading asks, how do you get that bid and offer indicator? Great question. Let's pull that up. So that's going to be outside liquidity. And I configure mine to show the visible price levels as well, because I want to see total order book liquidity and the delta for all of it. So let me know if you caught that. It's an add-on. It's called outside liquidity. I activate include visible price levels there. And we are seeing S&P futures continuing to push higher. We also see a sizable offer building above. It can act a bit like a price magnet. It's not large enough to constitute anything like a death cloud, where there's so much supply it can scare buyers away. This is not what that looks like, at least of yet. Part of it's also this band of liquidity that has been surrounding the S&P for the last month or so. But there's more to it than that, as we can see that that offer pre-existed the band moving higher. Let's take a look at the Russell here. It's just sort of the inverse of what's happening elsewhere. So I do dare say hedge funds are shorting the Russell to hedge out their NASDAQ exposure again, which is why small caps and NASDAQ can go in opposite directions for some period of time. It's also why I don't really think there's a rotation there, because earnings breadth in the Russell compared to the S&P is not very good. It's really about the inglorious 493 versus the small caps having some kind of growth story. They're just at the mercy of higher rates. They're struggling for a lot of other reasons. There's a lot of unprofitable companies in the Russell. So I would be careful with that compared to some of the higher quality large cap stocks that might be a better opportunity. And we do see some passive selling on the NASDAQ and some stop runs higher. Nothing that looks exhaustive yet, but certainly something to keep an eye on. Let's take a look at Bitcoin. Bitcoin more than made up for that initial drop, now boosting up to new session highs for the US cash session, just testing that point of control from below. Let's take a look at gold. Gold's sort of following Bitcoin's lead, but not quite to new highs yet, just sort of trying to reverse off of those lows from earlier. And crude oil just consolidating here in this range. And we did have a pretty significant iceberg sell order up there into that buy side, that stop run of buys. So that was shorts getting pushed out, 136 buy orders or buy contracts on crude. That just gives you a little bit of a sense. I mean, given that this contract's not very liquid, that gives you a little bit of a sense that someone big came in and just said, you know what, that's good enough for me. Now, we don't know whether they're opening a position to short or getting out of a long, but the signal is kind of one and the same. Someone with size said, you know what, I don't see it necessarily moving higher. So like to watch those because crude, like the NASDAQ, is not a very liquid book. This one is trading with a depth of 8.2 thousand contracts. So when 1050 comes in, when an eighth of the book comes in a single order, you pay attention to that. Go back to the S&P here. And we're just about 3 minutes away from forming that initial 20-minute opening range. We can see that once again, calls are outpacing puts. So far, a similar dynamic, about 2-to-1 on the two most active strikes, with that warm call way up there at about 56.51. And we are above my key pivot for ES. We went over those levels earlier. And we can see that hot call now moving down a little bit, but with a decent amount of volume behind it already this early in the day. 1,000 contracts transacting there. And the warm call, 998. So again, we do have that idea of magnetic pressure to pull us above, as these are easily outpacing what we're seeing out there in puts so far. So if we get that 20-minute opening range breakout to the upside, we already know where we may see that initial move go. And obviously these positions can change and adjust, particularly in the first hour, because folks are, there's basically a distribution of different price outcome thoughts being voted for in the market. The market's just a giant polling mechanism in essence. And the options auction of the S&P 500 is one of the most consequential for what we'll see in futures in the broader market. So we're going to very quickly bring up a chart from TradingView. And I'm just going to zoom this in a little bit more. So that pivot is 56.3175. I'd be looking for bullish trades above it. And the initial resistance levels I'd be looking at would be 56, 56.75, and then 56.90.25. We also may see a bit of resistance around 56, 71.25. That's about that 56.50 SPX options level translated into ES terms. Doing the back of the napkin math, don't hold me to it, but I think that's about spot on. And this is a pretty important level because we have seen a lot of transacting here in the near-term volume profile. The volume profile I have on my TradingView chart for ES is visible range. So we could get a little bit stuck here for a bit as we decide directionality. And we've got that 20-minute opening range now, and it's not bad. It's about 12 handles, and we're already starting to push above it. So for me, I like to see acceptance, 3, 4 handles above. Maybe we back test, but as long as we stay above that opening range, which we can see is defined just right here, just before that large green bubble on screen, as I realize you can't see my mouse cursor, that would be giving us a sense that we're breaking out. So far, initial signs look positive, but let's give the market a little more time to confirm that reading. If so, we already have targets. Look at how fast the situation is developing with that hot call, and look at how much it is outpacing the put activity. So that is another indication that there is a magnet that can draw price higher from here, potentially about 15 handles based on current levels. We also see a rather large bid down here just around the warm call, which is currently below price. And that's just at about the bottom of that opening range as well. So that's interesting, something to keep an eye on. And that was the 56.20 bid moving up about 5.5 points. And folks, I've got about 8 minutes left on the stream. Do be sure to come back next Tuesday at 9 a.m. Eastern. I do these every week on the Bookmap Discord, YouTube, Twitter, Twitch. So be sure to tune in. And if you have any questions that I didn't address on the stream, feel free to ask in the replies or comments. I always want to make sure that I'm trying to provide some value for you all, because my goal is to distill a lot of this information and hopefully help you get some more wherewithal about your trading process, about how to read this flow so you can incorporate it as it fits your desires, as it fits your need to get a better sense as to what's going on in the markets around us. And if you all want to learn more about what I do, visit Linktree. I've got the links on my Twitter feed. There's also some links here in the YouTube comments and elsewhere. You can find out more about my work on TraderAid.com. If you want to sign up, you can get a 20% discount on your first month or quarter using the code Mayhem20 at checkout. Or if you want to have a one-on-one coaching session to talk more about how I use Bookmap and develop your own systematic approach to trading, you can use the code COACHMAP for 20% off your first coaching, going to TraderAid.com and clicking on the coaching button. For Bookmap itself, you can get up to 40% off visiting TraderAid.com/bookmap. That's TraderAid.com/bookmap. And scroll down to the specials. And finally, the options visualizer is back on sale for a limited time at $39.99. Visit TraderAid.com/SPX to learn more and pick up a copy today. And we do see a passive seller up there just where we saw a little bit of resistance earlier. Only 14 contracts transacted so far by that passive seller. But that is something to watch here. Overall, it does look like we have a potentially bullish day in the making. But I'd like to see price move up just a bit higher, maybe to 56.39, 56.39.5. Make sure that we stay above the opening range for about 5 or 10 minutes of consolidation. And then I'd be saying, okay, this looks like a trend day, and we can reasonably target that hot call with our core of ES, going long into that, and then managing risk by saying if we dip back below the opening range, it's time to get out of that trade. So I'm sorry, I missed some questions here on the Twitter feed. If markets are getting too ahead of themselves like the beginning of the year, then the unwind will be another melt up. I don't know that it's going to look exactly the same as the beginning of the year. So I'm not sure that the unwind is going to look exactly the same either. And I would say that seasonality portends to more uncertainty about price outcomes over the next, say, 2 months until mid-October. So this time around, I think it's more going to look like perhaps just a bit of risk off, particularly on the front end of the yield curve and some of the longer duration risk assets like tech and growth, if Powell is successfully conveying that message that markets are overly optimistic about the Fed's cutting cycle. And we do see that break out of the opening range. I would call this a pretty decent confirmation. So I am inclined to go bullish here and target that hot call with my ES core position going long into this move. Silver is looking pretty good, but I want to see it rise above 30, 40, $30.40 to say that the swing bull trade is back on. Right? So I think it's recovering well. We're seeing demand from China improve, which is a really good sign because China is a big user of industrial silver. And silver is not just a precious metal. It's got a whole bunch of industrial uses. So that side of the trade has to really be engaged. And we're seeing some encouraging signs that it may be coming back. So above 30, 40, I think we've got room to get quite bullish on silver and some of its higher quality miners like Silver Corp or SVM again. And we can see that positive price pressure in ES is continuing here. We've also got the NASDAQ continuing to grind higher, breaking out of its respective 20-minute opening range. Russell just continuing to fall lower. Again, I think hedge funds are continuing to short the small caps to offset their long positioning in the NASDAQ. So the higher the NASDAQ goes today, that could put some more pressure on the Russell overall. It's all interconnected. And NASDAQ looking like, yep, there it goes, making another new high here. Some smaller traders getting stopped out. Similarly, ES making another new high here, continuing to push towards that hot call level that we identified earlier as an upside target for the core position that was put on that confirmed breakout of the opening range. This is how I do it. I look for convergence. I look for several different indicators that tell me that probabilities are thoroughly on my side. I'm not trying to call bottoms or tops. I'm just trying to repeatedly ride momentum and then get out and look for the next trade. Because over time, you'll realize trading is just a business. We're just moving inventory, buying and selling it, hoping to capture the spread. It's not supposed to be sexy or exciting or gambling or putting your whole portfolio all on black or all on red, like going to a casino. It really is much more about a systematic approach, managing risk first and foremost, and then making a system where you feel you can be consistent, where you can get out of losers quickly and only take the trades where the probabilities fall in your favor. And if they don't work out, they don't work out. You learn your lesson, you move on to the next. So I got a question about how I trade volume profile. I don't think I can provide a comprehensive answer in a minute, which is all the time I have left. I will just say this one big thing. I look at low volume nodes as key areas of potential support and resistance. And I look at high volume nodes as areas that can act a bit like magnets and get price stuck to it. So, above and below value, that can be interesting depending on your time frame. It can sometimes show you some degree of exhaustion, but it all depends. If you're above value in an uptrend, it doesn't really matter that much, just like being below value in a downtrend. So, folks, thank you so much for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem, in partnership with Bookmap. Again, if you want to check out Bookmap, visit traderaid.com/bookmap. It'll redirect you to a page. Scroll down to the specials. You can get up to 40% off. If you like the visualizer, visit traderaid.com/SPX. It'll take you to a page where you can click on a link and find the listing for the visualizer on Nadles. It's on sale right now for $39.99. And finally, if you want to check out TraderAid, visit traderaid.com. Go to the services page. You can get up to 20% off using the code MAYHEM20 at checkout. I'll see you folks next week, Tuesday, 9 a.m. Eastern. Have a great trading week ahead.